Hello ladies and gentlemen, good morning. I'm Joseph Novichkov, Senior Trading Manager for GDM with today's outlook. Second month of the year, starting with the Asian stocks, they fell for a third day after data signaled Chinese manufacturing shrank last month for the first time in more than 2 years. And of course the US economy grew less than forecasted. That's what we saw last week. Japan's Topix index slid 0.8% as the yen gained 0.2% to 117.26 per dollar after, of course, strengthening 0.7% on Friday. Australia's S&P 200 index rose 0.3% as energy shares gained. The New Zealand's 50 index fell 0.1%. And of course, the Aussie and the Kiwi are a little changed at 72.62 and 77.82 US cents last week's close. European stocks index futures advanced, indicating equities will climb futures after they posted the best start this year since 1989. Contracts in the Euro Stoxx 50 index expired in March, added 0.3% to 350 this morning. The Stoxx Europe 600 index jumped 7.2% in January as the Central European Bank announced an asset purchase program, even as Greek equities tumbled as a new government was elected. The euro is also little changed versus the US dollar at 1.1313 before the data in an hour time, where we expect moderate volatility. American consumers stepped on the gas as the fourth quarter, just as companies hit the brakes. The result was that while the world's largest economy grew at 2.6% annualized rate, the gain fell short of the median forecast. Cheaper gasoline and, of course, the largest employment increase since 1999 are boosting household confidence, increasing the odds that consumer spending can sustain gains following its biggest advance in almost 9 years. At the same time, of course, businesses' investments is cooling as companies such as Caterpillar says plunging oil prices, a rising dollar, and slowing growth abroad hurt sales globally. In the commodity sector, while we're at it, gold fell as investors weighed prospects for higher U.S. interest rates after the biggest monthly increase in 3 years. The price dropped as much as 0.4% to $12.7873 an ounce and traded at $12.7940 this morning. The metal advanced 8.4% in January is what we saw last month, the biggest gain since January 2012. Federal Reserve of St. Louis President James Bullard said January 30 that investors are wrong to expect the central bank to postpone an interest rate increase beyond mid-year. The policymakers cited a solid expansion of the economy in their January 28 statement. Higher rates, of course, cuts gold allure because the metal generally offers investors return through price gains. Now let's take a look at oil futures at the moment. They dropped as much as 3.3% in New York. The United Steelworkers Union, which represents employees at more than 200 U.S. refineries, terminals, pipelines, and chemical plants, stopped working on Sunday at 9 sites after failing to agree on labor contract. Rising U.S. supply has contributed to a global surplus that drove oil prices almost 50% lower this year. The price is steady at the moment, around the $47 a barrel level. And of course, for the economic calendar, today's most important news is Markit Manufacturing PMI for Europe and US. That's all for me for today. Thanks a lot for watching. Bye-bye.